All right, let's dive in then. We've got some really interesting source material here, specifically looking at an article by Chris Lehnes from June 12, 2025.
Hmm.
And it tackles something that, well, probably keeps a lot of small business owners awake at night.
Oh, absolutely. This deep dive, it's really all about a major vulnerability for smaller companies, The heavy reliance on just a few people, sometimes even just one person.
Right. It's like you build this thing, maybe it is just you, or you've got that star salesperson or the tech wizard holding it all together.
Mm.
And then you think, okay, what if they're suddenly not there?
Mm-hmm.
The material we're looking at really stresses this isn't just like a small problem. It can stop operations cold wreck relationships.
And the financial hit can be huge. Serious distress.
Exactly. It feels like it could be the end of the line almost.
Yeah, truly existential risk for some. And that's where this article brings in a specific tool, a strategic way to manage that risk. Key person life insurance.
Okay, so that's our mission today, using this source. We want to really unpack what this key person insurance actually is, how it works, and maybe, most importantly, why the article argues it's so critical for small businesses. Basically, why you might need to think about it.
Yeah, and we're coming at this from a risk management perspective because small businesses, like the article says, they just face different pressures. Success is often tied up in specific people, their skills, their connections.
Totally different from big corporations.
Completely. Big companies usually have backup systems, more layers, a deeper bench of managers. Small businesses often don't have that cushion.
Okay, so let's start right at the beginning. What is key person life insurance, fundamentally?
Well, think of it basically as a life insurance policy, but one the business buys on an employee who's just, well, essential, absolutely critical for the business to keep running.
Right. And the setup is different from, say, personal life insurance, isn't it? It's not for the employee's family.
That's the key difference. You really have to get this part. Who owns it? Who pays? Who gets the money? With key person insurance, the business owns the policy. The business pays the premiums.
Okay.
And this is crucial. The business gets the payout, the death benefit. If that person passes away, the key person is just the individual whose life is being insured.
Got it. So if that essential person dies, or maybe becomes seriously disabled if you have that extra coverage.
Yeah, if you have a disability rider, exactly.
The money goes straight to the company. So the whole point, according to the article, is giving the business the cash it needs to, survive that really tough period, keep things going.
It's about softening that immediate financial blow, buying time, really, for the business to figure things out and recover.
The article gives some examples of who might be a key person, and it's not always obvious. Founders, CEOs, sure. Top sales folks, tech leads, make sense. But it also mentions sole owners, partners, or even people valuable mainly for their outside connections, like the person who handles the biggest client, or the key supplier relationship. Maybe not a top exec, but someone holding vital keys.
And that's interesting, right? It's less about the job title and more about the actual specific value that person brings, whether that's unique knowledge, leadership, or those critical relationships that drive revenue or operations. If losing them hurts the bottom line, they're potentially key.
And that leads perfectly into why this is so vital specifically for small businesses. The article keeps coming back to this idea of high risk of dependency.
That's the core of it. Big companies, they can usually handle losing one person. They have processes, systems, other people can step up. Small businesses, often not so much. Success is built right on top of what a few key individuals do. Pull one out.
And the whole thing could wobble.
Right.
Or collapse.
Precisely. The whole structure is suddenly at risk.
So key person insurance steps in here, as the article calls it, a tool for business continuity and stability. The money, it says, can be used in lots of ways to keep the lights on.
Think about what that cash injection could do. It can cover lost sales while things are chaotic, pay for the transition costs, fund the search for a replacement, which isn't cheap.
Definitely not.
Pay off loans that banks might suddenly want back, keep you from defaulting on contracts. And maybe just as important, it sends a signal of stability. It reassures lenders, investors, even the remaining staff when everyone's feeling nervous.
That bit about protecting stakeholders is really important, I think. The article talks about how losing a key person can put loan agreements at risk. Suddenly the bank sees more danger.
Yeah.
Investors might get scared off. Clients could lose confidence and leave. Or, like we said, the business might just have to shut down.
Yeah, the ripple effect goes way beyond just the immediate financial hit. It impacts everyone connected to that: business employees, customers, suppliers, the bank, everyone.
Okay, let's try and make this even more concrete. The article uses some real-world scenarios. which I think really help illustrate how this insurance actually works in practice.
Yeah, these examples definitely drive the point home.
So scenario one is what they call revenue shock.
Mm.
It describes this solopreneur running an agency, really successful, but he was the sales engine, the strategist.
Mm.
When he died unexpectedly, the income just plummeted. So fast they couldn't even make payroll. The whole business closed down in 3 months.
Wow, that's brutal. It really shows how fast things can fall apart if everything rests on one person and there's no financial cushion.
Yeah, no safety net.
Yeah.
Then there's the debt repayment scenario. The article points out, business loans are often approved based on the strength of a specific owner or key exec being there.
Right, the lender trusts that person.
So if that person dies, it can actually trigger clauses in the loan agreement.
Mm-hmm.
The bank might be able to demand all the money back right away.
Ouch.
Insurance funds can basically pay off that debt and stop things from spiraling.
Yeah, it keeps those critical credit lines open. Absolutely essential.
Okay, third one, the cost of replacement. Finding and hiring a top-level person. It costs a fortune. The article throws out figures like tens, even hundreds of thousands of dollars. You've got recruiter fees, maybe signing bonuses, plus all the lost productivity while you're searching.
And the time. It takes time to find the right person, get them up to speed.
Exactly. There's this great example in the text about a tech startup. They had $1 million policy on their CTO. He died, sadly. But that $1 million payout, it let them recruit a really top-notch replacement, handle project delays without losing clients, and basically avoid breaking important contracts.
See, that shows how flexible the funds can be. It wasn't just hiring costs. It was about keeping the whole operation stable, managing expectations, and buying that crucial breathing room. Time to make good decisions, not panicked ones.
And the last scenario connects back to something you mentioned, ownership buyouts. Especially in partnerships. There's this example of a plumbing business, 2 partners. They took out key person policies on each other, a cross-purchase setup.
Ah, okay.
When one partner died, the surviving partner used the insurance money to buy the deceased partner's share of the business right from his estate.
That is such a smart application. It gives you a clear, funded way to handle that ownership transfer. Avoids messy legal fights, probate delays. The business just keeps going, really smooth.
So, okay, if you're starting to see the need, the next question is obvious, right? How much insurance do you actually need? And the article is clear. There's no magic number.
No, definitely not one size fits all. But the article does lay out a few common ways businesses try to estimate it.
One way is the multiple of salary approach, like maybe 5 times, maybe 10 times what the key person earns each year.
Or you could try to figure out their direct contribution to profits. How much revenue or profit are they personally driving? Try to ensure that amount.
Another angle is replacement cost.
Yeah.
Literally add up everything it would cost to find, hire, and train their successor.
Or simpler maybe, just make sure the policy covers any outstanding debt that might get called in if they were gone. The article really pushes for a tailored approach, though. Combining these ideas based on your specific situation. Like, what industry are you in? How hard is it to replace someone like that? What other backup plans do you have? Are you a startup or a mature company? All that stuff matters.
And then there's the actual type of insurance policy. The material mostly talks about 2 main kinds used for this.
First is term life insurance, generally cheaper, right?
Yeah.
Covers you for a set time, 10 years, 20 years, whatever.
Right. The article suggests this is good if the need is temporary, maybe tied to a specific loan timeline or a crucial growth phase. It's kind of like renting the insurance coverage for a fixed period.
Okay, renting it. I like that.
Then you've got whole life insurance. Costs more, typically, but it covers the person for their entire life as long as you keep paying. And a big feature here is the cash value. It builds up over time, and the business might be able to borrow against it.
And the article mentions that's often used for longer-term stuff, like funding those buy-sell agreements we talked about earlier.
Exactly. It provides that permanent funding mechanism. The text also flags some useful extra you can add riders, like a disability rider. So it pays out if the key person becomes totally disabled, can't work, not just if they die.
Yeah, which is a really important risk, too. And there's an accelerated benefit rider lets the business access some of the death benefit early if the person gets a terminal diagnosis.
So more ways to protect the business financially.
Definitely extends the safety net.
Okay, shifting gears a bit to the practical side. What about actually getting the policy, the application process?
Well, it's pretty much standard life insurance underwriting. So the key person usually needs a medical exam. The business has to provide financials.
Prove you need it.
Right, prove insurable interest. show that losing this person would genuinely hurt the business financially.
And here's a really big one the article stresses. Consent is mandatory. The person being insured has to agree. They have to know the business is the beneficiary. That sounds potentially awkward.
It can be, absolutely, a sensitive conversation. The article gives some good tips on how to talk to your team. Transparency is key. Frame it as strategy about protecting the company, not about their personal mortality or replacing their own insurance.
Yeah, that's a good point. It's about business continuity.
And the article points out potential upsides for the employee, too. It's solid proof of how valuable they are. It can even boost their sense of job security, seeing the company plan around them.
And some policies might let them take it over personally if they leave later.
Sometimes, yeah. There can be conversion options. The article also mentions taxes generally. The premiums aren't deductible for the business, but the payout is usually tax-free to the business. But, tax rules can be tricky. Always check the specifics.
Which leads right into the need for advisors.
Oh, for sure. The article strongly recommends getting professionals involved.
Like who?
An experienced insurance broker who really knows key person policies, lawyers, especially for those buy-sell agreements, accountants for the tax side, maybe even financial planners to see how it fits the overall picture.
Makes sense. And the article also says, look, this isn't something you set up once and forget about. You need to review it regularly.
Absolutely critical. Businesses change. Maybe the amount of coverage isn't right anymore. Maybe someone else has become key. Or maybe someone's role has changed. The policy has to keep up.
Okay, but it's not all smooth sailing. The article does mention potential drawbacks and considerations. Cost is one, right? Premiums can be a real line item, especially for a small outfit.
Definitely, though it does suggest things like annual renewable term policies might start cheaper, even if costs rise later. Something to explore.
Another potential issue mentioned is employee morale. Like, if you only insure one person, do others feel slighted?
It's possible. The suggestion there is to balance it maybe with other ways you recognize and reward the rest of the team.
And finally, just the complexity. It's not just about having the policy, but integrating it. The article says the funds need a plan earmarked for recruitment, debt, whatever, not just dumped into general revenue.
Right. It needs to be part of your strategic planning, which really underscores that key person insurance is one piece of the puzzle, not the whole solution.
So that brings us to the alternatives and supplements the article talks about. It's not just about insurance then.
Not at all. The cross-purchase thing we discussed is one tool, but the article really pushes for comprehensive business continuity plans. Insurance supports the plan.
What else goes in that plan?
Things like documenting your key processes so someone else can step in if needed, training backup people for critical tasks, spreading out your client or supplier relationships so you're not too dependent on one person's network.
That makes a lot of sense. Diversify the risk internally.
Exactly. And, of course, working hard on employee retention strategies.
Keep your key people from leaving in the first place.
Right. Happy, engaged people are less likely to leave voluntarily. Insurance is the backstop for the sudden, unpredictable loss, accident, illness. Retention helps manage the controllable departures. They work together.
Okay, so wrapping this deep dive up, drawing on everything in this article, the main message seems really clear. For a small business, losing that key person isn't just a setback. It can be.
Existential. That's the word the article uses, and it feels right. Unlike big companies with buffers and backups, a small business's stability is often tied directly to the people driving it. Take one away suddenly.
And the whole thing can shake apart. So the article really frames key person insurance less like just, a precaution and more like a core strategic move.
Yeah, it shows you're thinking ahead, managing major risk, and serious about the long-term survival of what you've built.
And yeah, there's a cost. Premiums aren't free.
Yeah.
But the article makes a strong case that the peace of mind, the actual financial safety net it creates, that's worth a heck of a lot compared to the potential cost of not having it.
It's weighing the known cost of the premium against the unknown, but potentially catastrophic cost of a key loss without a plan.
So if your business really leans heavily on one or two people, their skills, their contacts, their decisions, the takeaway from this material feels pretty direct. You really need to look hard at key person insurance. It's about protecting, everything.
And maybe the final thought the article leaves us with is this. Is putting that protection in place really optional? Or is it actually fundamental to safeguarding everything else, your employees' jobs, your customers' trust, your own future? What's the true cost, the hidden cost, of simply hoping for the best and having no plan B?
Definitely something serious to chew on for anyone running or building a small business. Thanks for joining us on this deep dive.